Welcome back to the channel. A lot to unpack, a lot to talk about this week. Going to take a different approach with it. Going to go off on a rant about the Bank of Canada hitting the pause button. No fancy stuff, just straight talk with the Bank of Canada with their most recent press conference and their decision to hold. Now, ultimately, did the Bank of Canada do the right thing on April 16th? Should they have cut? Should they have maybe held? And this is really a point that's up for debate. A lot of voices on social media, a lot of people talking about the Bank of Canada needing to cut, and a lot of economists saying the Bank of Canada did the right thing. Now, ultimately, depending on what side of the aisle you're on, obviously you will share your own sentiments. But I think it's important to understand that the Bank of Canada did decide to hold with the ability to make a decisive decision between now and their next meeting in June. Their meeting is obviously set for June, July, and ultimately the Bank of Canada, although they may not have to act on an emergency cut or one that is ahead of the next Bank of Canada rate announcement that is scheduled, the Bank of Canada does have the ability to do it if need be. Now, ultimately, we're going to invite everyone to subscribe to the channel if you haven't already done so, just so that you can stay up to date with things that are happening, especially around the Bank of Canada now hitting the pause after cutting 7 consecutive times in an economy right now here in Canada that is facing significant uncertainties, these tariff scares from Donald Trump and the US administration. Obviously, there's a lot of contention happening in the US. Totally different economy, ultimately one that is a lot more resilient, but the recessionary fears are prevalent in both economies. I mean, it's important to understand that ultimately nobody wants to have a recession, especially Donald Trump being 4 months into power. Doesn't want to be going down in history as the president that hit the recession or caused a recession based on tariff wars. But here on this side of the border in Canada, we ultimately have to deal with the reality of what's happening globally, what's happening with our partners to the south. Whether you agree or disagree with everything that's happening, ultimately these tariffs are reality. The uncertainty is causing havoc in the stock market, in the economy, with businesses. I mean, no business is able to plan to hire, fire, invest, do research, and continuously, maybe build more locations. This is really reality with all these scares and tariffs, especially if you're a business that relies on imports, exports, items from China or so on in the entire globe. This is obviously going to have an impact. And ultimately, here in Canada, we've seen, especially with the most recent talks of interprovincial transfers, like basically a lot of opportunity opening up here in Canada. I mean, that's for another conversation, but I mean, we're starting to get some good signs here to help alleviate a lot of these pressures that could be coming in from these tariffs in the US. Now, it's important to understand the tariffs are coming, they're going, they're added. Liberation Day, 2,000% tariffs on China, or like 200% China tariffs on China. Does that mean really they're coming in, they're excluded? No, they're only applicable to phones and semiconductors. But here in Canada, it's, tariffs are on aluminum and steel, and are we seeing exemptions on the automotive? What does that mean? What does that translate to when it comes to manufacturing, especially with Ontario getting hit the hardest, right? I mean, why did Ontario get hit the hardest? Well, obviously, big automotive sector here. Now, all that is basically just a quick sort of summary on what's sort of happening, right? It's the uncertainty. So you have on top of this, the Bank of Canada getting the inflation print coming in a lot lower than expected. I mean, the economists, even the Bank of Canada predicting it 2.6, 2.5, and it came in at 2.3. I mean, so we have definitely inflation trending in the right direction. A lot of that lower inflation did come on the back of the fact that gas prices have come off. Reality check now with the full month of March being without the GST, HST holiday. So ultimately, we are going to see, the reality of things settling in and how tariffs are really going to play out. I mean, we have unemployment, as I said, ticking up to 6.7%, losing 33,000 jobs. Not ideal. You have the Bank of Canada's own Consumer and Business Outlook survey telling them that businesses are pulling back. They're not hiring. That means they're potentially, going to be stagnant. When you start to when you stop hiring, well, you begin to start firing, right? And if the businesses are starting to get impacted, then businesses are going to have to protect their bottom dollar, their margins. So we can see how that can snowball really quickly. And the Bank of Canada knows this. I mean, this is coming directly from their outlook surveys. Consumers' expectations on inflation are rising. People are thinking, hey, if we see these tariffs, even though tariffs generally are a one-time shock to prices because it comes in, hey, that item is going to get tariffed at X amount. That's how much that item is now going to be cost. That's going to cost in the market. But ultimately, with all this uncertainty, even the Bank of Canada really preparing, 1 and 2 scenarios. I mean, one being the best case, where tariffs get pulled back, base case scenarios, very minimal tariffs. Then worst case scenario, tariffs on China and Canada at the full brunt. That obviously leads the Bank of Canada into recessionary talks. These are things that were brought up at the most recent press conference, amongst the fact that the traditional questions about, hey, why didn't you cut? Do we see a 50 basis point cut at the next meeting? But, there's even been questions now about rate hikes. And something we've talked about, if you're following the channel, we've talked about the possibility that the Bank of Canada will maybe have to hike rates at some point. I mean, it's not out of the question, right? So the Bank of Canada could hike. I mean, ultimately, maybe not right now. Remember, they're going to deal with the tariffs. They're going to have to try to manage this situation as it stands now. Shoot now, ask questions later, as we said. But the Bank of Canada itself, looking at what is to come, has to make a decision right now. We have the potential for what we call stagflation. That is where inflation continues to rise here in Canada. The economy, the economic output, GDP, continues to fall. Unemployment continues to rise, right? So the Bank of Canada is stuck in a position where if we have inflation rising, but the economy is not performing, the Bank of Canada can't really move or rebalance the rates down without impacting one side of the pendulum, right? So it goes up and down. So the Bank of Canada, if you look at it, has a very tough road ahead of it. And maybe they want to get the overnight lending rate, the Bank of Canada policy rate, the one that's now at 2.75, that remains unchanged, right? Very clear, down to maybe 2.5, maybe lower, depending on where they see the economy. But here's the thing, the Bank of Canada is not giving the forward guidance, right? They're not coming out and saying, this is how we're going to deal with it. And this sort of gives me, at least in my opinion, the reason why the Bank of Canada is not sort of laying all their cards on the table face up, right? They're saying, okay, look, we can't give you forward guidance because if we tell you what we're doing, then you're going to plan for what we're doing. So if we're going to tell you, hey, interest rates are going to come down, then maybe they will start to see more people spending in the economy instead of being a little bit more cautious, which ultimately is a good thing, right? If the economy is not performing and you're trying to stimulate the economy by lowering those rates to get people out there, then wouldn't you want to lower the rates, right? This is where we're sort of stuck in this dichotomy. I mean, and then on the other flip side is, well, you also don't want consumers to maybe start buying more things thinking that things are going to get better, right? Because maybe things aren't. Maybe this is a big warning sign to Canadians to say, hey, look, we have a recession potentially flashing in front of us. We have stagflation. We have uncertainty. This is not the time, and ultimately the Bank of Canada hitting the pause button signals that, right? By continuing to cut, the Bank of Canada, every time they have these meetings, it goes without saying that they have to justify. Not only does the governor of the Bank of Canada come out and give his prescribed reading, the deputy governor there to answer questions, but the governing council, they have to give reason. And if they were to cut rates at this time, stating, everything that they're sort of alluding to with the 2 case scenarios, best and worst case recessionary fears, stagflation, inflation increase, uncertainty, it's not really a good sign saying, hey, we're cutting rates because the economy is in a complete and utter tailspin, which I don't think it's there yet, especially here in Canada. I don't think we're in a full-blown tailspin, although some people say, well, what about the real estate market? It's, the inventory levels are spiking, sales are down. I mean, ultimately, you get the picture. The data here is not looking good for a lot of the housing data. Now, I mean, ultimately, there's different pockets, different segments of the market that may not feel the same pressures. Now, we're not talking here about what's happening in the real estate market per se, but the Bank of Canada itself isn't focused on the real estate market. The Bank of Canada, over the last couple of meetings, really hasn't put a lot of focus on the real estate market. You remember, and we've talked about in the previous episodes, the Bank of Canada isn't monitoring the housing market and making policy rate decisions because of what's happening in the housing market, right? The Bank of Canada is looking at inflation. And we've talked about on the channel before, the Bank of Canada has a single mandate with, I would say, a 1.1 or 1.8, right? So one being inflation, super important. Bank of Canada is to talk about inflation. They have to address inflation, keeping it that 1 to 3% bandwidth. And what happens if inflation continues to get closer to that 3%? Will we see, if it gets to 3% or more, will they hike rates? And ultimately what happens with unemployment. And you bet your bottom dollar that the Bank of Canada, although it's a silent mandate, the Bank of Canada is looking at inflation, they're looking at employment, they're looking at unemployment, and they're making sure that they can balance this economy. And right now, maybe they're willing to sacrifice a little bit of time, right, until June, right? Literally like 40 days, 42 days, 43 days from now, before they have to make their next decision. And with the possibility of coming out saying, hey, if we need to make a decision ahead of that, we can do that, by the way, but it's not a code. It's not saying we're going to do that, but just to remind people, hey, let's just take a second to step back. Now, ultimately, this leads for the conversation on rates and ultimately what's happened with Canadians. A lot of our clients right now reaching out. Once again, talking about those rates, variable rates, maybe still popular. Bank of Canada maybe cutting conditionally a few more times. Remember, Bank of Canada has 8 meetings, right? We have 8 meetings a year. Will we see more cuts? That's literally the question. I think we potentially will see a cut. I still think the Bank of Canada is going to cut a few more times, but when will they start hiking, right? At what point? That is the question. And ultimately, fixed rate mortgages based on bonds. We saw what's happening in the US, obviously, with the treasury spiking in the US. The US rates have moved up for 30-year mortgages. That's also causing rates over here, a lot of those discounts that we previously saw here in Canada, to sort of dwindle away. And you bet your bottom dollar, if this continues, we'll definitely be having a different conversation about rates. And we'll be doing an episode in the next little while to talk about where rates are. But ultimately, things are all over the place right now. We're getting insured rates as low as, under 4%, and then some conventional mortgages just slightly over 4% into the mid fours, depending on what clients are looking at and where those discounts are. So, ultimately right now, it's a really tough time, especially for those looking to renew their mortgage. If you have a mortgage coming up for renewal, you're looking to find out more information, reach out to your mortgage professional, get something unlocked, lock something in just in case those rates end up going higher, right? If at least you lock something in now for 120 to 130 days, you have something in writing on paper. And if that rate continues to go up, then you're hedged your bet. If it goes down, then your broker, your bank should be giving you a lower rate. It doesn't automatically happen, so you got to reach out to your mortgage professional about that. But if you have a question about your mortgage, always feel free to reach out to us here at InTouch Mortgage Solutions. We're more than happy to help answer those questions. Leave them in the comments section below and we'll get to them. But until next week, thanks again for stopping by, and we'll see you all next week.